Bibow Real Estate says it doesn't require a capital increase, but warns further serious turmoil in international markets make it impossible to give an outlook for the business. Swiss Life higher in Zurich after the firm promises a bumper payout for investors and reports a better than expected 43% jump in full-year net profit. London-listed hedge fund management group, Man Group, also trading higher as it sounds a bullish note saying it'll beat analysts' forecasts for the full year. Swedish clothing firm H&M pleasing the market, quarterly net profit beating forecasts thanks to a strong pickup in sales over February. And Kingfisher slides to the bottom of the FTSE after slashing its dividend by 30%. The DIY retailer vowing to restructure its underperforming Chinese unit. We're back, everybody. This is Squawkbox on CNBC Europe. I'm Jeff Cummer. Let's just tell you, Robert Bibow has joined us around the table. Robert is a partner at Atlantic Pacific. That's a private equity business. Robert, nice to have you with us. Michael, I just wanted to re-engage in our conversation for a moment before we get into the discussion about private equity. Chris Dodds, the Senate Banking Committee chairman in the US, is saying, we want to talk to everybody about this Bear Stearns bailout, if you want to call it that. The head of the Finance Committee also wants to be involved because this is $30 billion of public money that's being brought to the table here. Moral hazard is the issue, it would seem, and they really would like to know what the responsibility is of the Fed at this point to bail out the banking system. Is there a risk that this generates adverse negative market reaction? I mean, that the market says, hang on, we thought the Fed was able to do what it needed to do.
Market,
now the legislators are going to step into this and prolong the credit crisis.
There has to be. I'm sure there will be some sort of deal cut behind closed doors, but at the end of the day, if there were any threat to the Fed having the ability to bail out the interbroker-dealer market, which is what it did last week, then that would cause a significant run on financial assets again, because the bailout clause will have been removed. So political, I'm not going to say interference, because I think it's the fair questions that these guys are asking. But if there is a threat there, we should price that into the market, and that will not be a positive price reaction.
Do you think that, given the experience of Sarbanes-Oxley, that the American legislators are very mindful of, that they will be wary about being perceived to take action that will be misread by the market?
Well, let's just kind of broaden that out a little bit and put it into a slightly different context. The way that the markets worked between 2003 or 2000 and 2008 is never going to be repeated again, for two reasons. One is obviously the shareholders are going to say, why are you doing that? We think that's very risky. Look at the write-offs that we've just taken. Can you imagine somebody letting the UBS management play the games again that they have over the last 5 years? I think not. The second thing is that business is going to become much more regulated, and the balance sheets of the broker market, the interdealer broker markets, are going to become significantly regulated. And that obviously is a critical step that we've taken here with the Fed moving into the investment banking market. The flip side of that coin is, if you want us to give you money, you've got to allow us to regulate you. The SEC regulation clearly hasn't worked, therefore we must do something else. And as you say, you go to Sarbanes-Oxley and you get some, the horror of very tight, very intense regulation, which again doesn't let that market work. So there won't be any buyers for the stuff anyway. The market will be regulated down quite aggressively. I think that changes the way we create credit, obviously, going forward. And that means that from a global perspective, let alone a United States perspective, there is going to be much less credit around.
Robert, let's bring you in on this, because I think that's a great place to start a conversation about private equity, because without that credit creation and the ability to leverage, that inevitably suggests that this halcyon period of private equity deal making, where we saw ever larger numbers in the headlines, is over.
I'm not sure that's true. I think what you're going to see is a reversion to fundamentals and a focus on what really matters to people, which is, do the numbers stack up? In the past, you've had banks financing things because they knew they could sell them off in the securitization market. And what's happened is that securitization market has very much gone away now. It's gone. It may come back. It will come back at some point, but for a while it's going to be gone. And so what people have to look at is deals. Are they very comfortable doing them? Are the banks comfortable doing the deals and holding that debt on their balance sheet, knowing that there may not be an exit for it? And for a long time, they haven't had that.
But that takes the financial player out of the market at this point, doesn't it? I mean, a trade buyer can step up if they can demonstrate reasonably deep pockets to be involved in the deal, but the leverage is gone.
I think there's still the leverage is there for the right deals. I think there's still a market, absolutely, because now is a tremendous time to be in the private equity business. If you take a look historically, I've been in this business since 1989, and if you take a look historically where funds have made the best returns, it has always been in markets like this when asset prices are cheap and you really have to look at the best deals. And right now, it is a great time to be in private equity.
Robert, if I can just jump in. You've been in this business 19 years, and doesn't the industry, whether it's the banks or whether it's private equity, don't they owe an apology? I don't expect an apology, but really they do owe an apology to pretty much everyone out there who relies on the global economy, because what they've done under the premise of saying, well, we're doing these deals so that we can get efficient capital situations at these companies, efficient balance sheets. You aren't geared up enough. They sold us this mantra, just like the analysts tried to sell us EBITDA in the dot-com boom. They sold us this idea that if a company wasn't geared up to the hilt, it wasn't capitally efficient, and hence they've got a lot of responsibility for the problem we've got now.
Well, I don't think we want to oversimplify this. I think the role of private equity is to take companies that could be better managed or where there's an opportunity and add capital to grow that opportunity. And oftentimes private equity firms come in and they grow companies very successfully. If you take a look historically at private equity companies, they tend to perform better, ones that are bought by private equity, than ones that are publicly listed. And so that's got to tell you something about it. This isn't a new market. Private equity has been around for a very long time. It's just more in the news now.
But the point is, yes, you're right, there is a large tranche of traditional private equity activity, which I'm sure, I'd say from 1989 onwards, was a bread and butter of the industry. And then there was this new mantra that came about, as I say, this extra gearing, this we've got to securitize everything, we've got to gear these companies up to the hill. That's the bit, that's the froth that's come, and hopefully will just go away again, and we'll be left with an industry, as you say, that does create jobs, that does grow businesses, that does create efficient businesses. This over-gearing lark is what we've all got a problem with, isn't it?
Well, I think your point is very good, which is some private equity firms have relied only on financial engineering to be successful, and that is frankly not a sustainable business model in this market. But ones that do approach businesses from a fundamental business improvement point of view, improving productivity, getting more out of the business, growing it, expanding it, that is a market that's always going to be there, and that's something we're very comfortable with.
Michael.
Two questions. One is, if assets are so cheap and private equity pockets are so big, why haven't there been any deals done? I look at my market and I think, hang on, if it's such a great idea, why is nobody doing any deals? The second question, which is the flip side of that, is where do you go now for an exit? The equity market's pretty much shut. You can't re-leverage that company to take some cash out of it because the banks won't lend you in the same multiples that they did before. So how do you, from a private equity point of view, get an exit in the next 24 months?
Well, I think if you're looking for an exit in the next 24 months, maybe that's not the right thing. But you have to remember, private equity is a long-term game. It's not something you're in for a year or 2 years. Private equity funds are 10-year vehicles. And 10 years from now, if you're comfortable saying there's no exits, then I don't think anybody should be in the private equity business. But I think, you know what? Companies are going to have to exit. Maybe they'll have to do it differently. The IPO market will open up again. It's just a matter of time. Maybe a while, but you know what? If these companies are fundamentally well managed, then they should be comfortable. People should be comfortable investing in. And if there's a longer hold period for a company, that's sometimes the way it is. You have to wait for the right exit, not, you can't time the market sometimes.
We come back to the first question. Why no deals? Why has no deals been done at the moment?
Well, I think you're seeing very few high-profile deals. And the reason you're seeing very, very few high-profile deals is because, and smaller deals are definitely happening, but those don't make the papers. Nobody reads about those. The big high-profile deals aren't happening right now because the big syndicated debt market is closed. And it's going to reopen at some point and it'll make the news, but right now there just isn't enough firepower in banks to go out and lend to these things. That's why you're seeing problems.
Louise.
Is there a big difference between the medium-sized deals and the smaller deals? And I'm ruling out the big deals on purpose because that's where we're seeing the drying up, right?
Yeah.
I mean, so the small size and the medium-sized deals, I mean, where are you seeing the most activity now? And
Well, I think we're seeing activity across the board. There will always be activity because there are guys who are in private equity firms who are paid to be out there looking at deals and doing deals. So there's always going to be activity. Whether deals close is going to be a financial matter, and it's really a question of do the numbers stack up and does this make sense. In the small and medium-sized market, you have many more people who go after deals that really require fundamental restructuring and growth. There's less management talent in smaller companies than there are in larger companies. Larger companies, generally big buyouts, rely on financial structuring. That was the case 20 years ago, 10 years ago, and it's still the case. So as long as that financial engineering market is somewhat closed, which it is now, you need fundamental improvement in the companies.
What are we going to learn over the next month or so as the essentially the report cards come back from a lot of these private equity companies on the businesses that they've managed through the last year or so? Are they going to be able to show and demonstrate that their involvement with the management teams have wrought significant benefits and value for the businesses? Or are we going to learn actually that the leverage that they've built into these companies is going to sink many of the businesses that they came into and got involved with?
Well, I think looking over the next month, it's private equity is a long-term game. So over the next month,
but there are a lot of investors who want to know what they've got for their money that they've put into the funds.
Yeah,
and this is the time when the KKRs and all these other companies are going to start having to report that.
Yeah.
So, money is not long term. Money is short term.
Yeah, but in private equity, actually, it's long term. It's committed for 10 years. But I'll get back to your question, which is what's going to happen. I think investors are going to start asking questions about what's going on, and I think bit by bit, though, over time, the market will move on, and it'll be fun.
Robert, I think there's another reason why deals aren't getting done, and correct me if I'm wrong, I think they're worried about the exit route, and I think what Merrill's did yesterday in Debenhams shows to me that the exit route is very tortuous as well, knocking stock out down to 60 pence in a stock that floated at 195, not even telling your private equity partners that you were doing this deal.
Yeah.
There's a lot of pain out there still, isn't it? And I think they're worried about the exit route.
I think you're right, and I think also another thing which is crucial right now, which is that the term in the business is nobody wants to catch a falling knife. Nobody knows how far value is going to fall, and everybody wants to buy at the bottom of the market, not before it bottoms out. And so people are looking at the market saying, gee, that's a fantastic deal, but it would be even better 10% cheaper. So that's what people are looking at now, and that's another reason why you haven't seen a lot of deals, because people are saying, maybe there's better opportunity for me 3 months from now.
Robert, we've got to let you go, but thanks very much for coming in and fielding the questions. Robert Bibow joining us, partner at Atlantic Pacific Capital. Michael Brown stays with us. Some more of your questions to him. Still on the program, Hippo Real Estate scraps its full-year profit forecasts. But is this the transparency that investors have been looking for? We'll talk to some shareholder activists. We invited the company on. They were unavailable, but we'll be back. We'll talk about the story.